Hey everyone, Adam Bergman here, tax attorney founder, IRA Financial. And on today's YouTube live session, funny new Senate retirement law passed. So I briefly covered this in a podcast a week or so ago, but now that the bill actually passed the Senate, I did the podcast right before it. So I wanted to do a video and talk about some of the key provisions, how they differ and how they're the same based off a recent House retirement bill passed in late March of this year, and kind of go through some of the important provisions, because there's a lot of really cool stuff here. And I've mentioned this repeatedly, that the retirement system is the one system that works. Why? Because there's bipartisan support. This Senate bill was passed unanimously, right? Tell me any other piece of legislation that gets passed unanimously in Washington these days. Doesn't happen, right? Impossible. So I thought this was worth chatting about because it's so monumental. The House bill passed pretty much unanimously as well, 414 to 5. Okay, so again, whether we're dealing with healthcare, definitely don't want to even touch the Supreme Court recently, but our country's certainly divided, and there's hardly any issues where there's bipartisan support on both sides of the aisle. And the retirement system is the one system where there generally is support. Why? Because it works. So I wanted to highlight some of the really key provisions. There's a good chance this passes in its entirety. Right now, the process is the House bill passed, which was known as the Enhancing American Retirement Act, which is the Senate version. The House version is called the Securing Strong Retirement Act, 2954, which again passed late March 2022. What's going to happen now is that these bills will kind of go to committees, and ultimately one bill will get packaged, aggregated together, and will be signed by the president sometime this year. That's going to happen. There's a lot of consensus behind this. The theme for both bills, the House and the Senate bill, is an important theme, and I agree wholeheartedly with it. It's to make it easier for all of us to retire, make the system easy, make it more accessible, cheaper for all of us to get access to retirement accounts, and more flexible. Okay, and I think going through these key provisions, you're going to see that theme blossom, because that's ultimately what the House and Senate want to do. So let me start with some of the key ones. The first one, and this is really no particular order, I'll leave the 401k stuff to the end because I wanted to focus more on IRAs, solo 401ks. Some of the larger ERISA 401k stuff I'll kind of leave at the end. Most of those involve auto enrollment anyways, so not wholeheartedly relevant to self-directed IRA and solo 401k investors, but nonetheless wanted to talk about it. So let's start with RMDs. Right now the RMD age is 72. It was 70 and a half, the Secure Act 1.0, which was passed the end of 2019. Hard to believe, almost 3 years ago. Moved the RMD age from 70 and a half to 72. The House and Senate bills both want to move it to 75, and that's going to be gradual over the next 10 years. So it'll be 73 from 22 to 30, 73 from 22 to 28, 74 from 29 to 31, and then it'll be 75 after 2032. So over the next 10 years, this is going to cost the IRS money, right? As you extend the RMD age, that means you're going to let people hold their retirement accounts longer and ultimately not force them to take taxable distributions, which will actually have an impact on tax revenue. So that's why they wanted to do this gradually. This is the same in the House and Senate bill. This will happen. We're all living longer, and there's a big push by Washington to give Americans more retirement flexibility. Right now, if you fail to make RMDs, it's a pretty big size penalty. It's 50% of what you owe. So they want to reduce that from 50 to 25%. And to 10% if it's corrected promptly. So they understand, listen, people are older. This stuff is confusing. Sometimes you don't get the full RMD picture. Let's say you have IRAs at different institutions. You have an IRA and a 401k. You don't understand. No one tells you that there's different RMDs for IRAs and 401ks. You can't just aggregate the different type of retirement plans. And people mess up, right? Or they're traveling, they're sick, whatever the case is, and they forget to take the RMD. Now it's a pretty big penalty. If your RMD amount was $5,000, you got to pay a 50% penalty on that. They want to reduce that to 25 and 10%, which I'm all in favor for. So that's going to pass too. That's going to start in 23. They want to next. Roth accounts in a 401k plan would not be required to take required minimum distributions. Right now, if you have a Roth in a 401k, even though it's a Roth, you have to take an RMD. There's certainly an easy workaround. What you do is before 12/31, just move all your Roth 401ks to a Roth IRA, do a tax-free rollover from the Roth 401k to the Roth IRA, and then you have a zero balance in your Roth 401k as of 12/31, and then ultimately there's nothing to take as an RMD. So they realized this and said, well, that's kind of foolish. Why don't we just have the same rules as the Roth IRA and just not force people to take RMDs? Since the account's not taxable anyways, we're not really winning, so what's the point? So that will pass as well too. There's momentum behind that. This is interesting. They want to index IRA cash contribution. So the $1,000, for example, it's $6,000 if you're under 50 right now, $7,000 if you're over 50 to do an IRA contribution. They want to index that to inflation, the $1,000, which will allow that $1,000 number to expand in the future. Right now, it's not indexed for inflation. So that's an important point that both the House and the Senate bill have. The next one, Roth employer contributions. This is interesting. They basically want to have employees elect, if they want, to have the employer matching contributions be in Roth. So right now they're in pre-tax, and they want to basically allow the employee to do it in Roth. The idea is that potentially could be taxable to the employee, but the contribution will ultimately be Roth. Just as a recap, why do people Roth? Well, once you're over 59 and a half and the Roth's been open at least 5 years, it's all tax free. So that's the whole concept behind the Roth, is the point of generating tax-free growth. So that's something, again, that will pass. There's definitely a push to have more of a more, I would say, driven approach where more retirement account holders have Roth, even though from a long-term standpoint, that isn't really smart, because down the road, if more people have a Roth, that means there's going to be less taxable revenue in the form of required minimum distributions, because Roth IRAs don't have RMDs. But as I've mentioned repeatedly on many podcast videos and blogs, governments think in generally 4 to 8 year windows. That's when they're in office. That's what they care about. That's what the budgets are based off. So they don't really care what happens in 30 years. So in the short term, Roths offer a tax advantage because there's less deductions. If more people are taking Roth contribution or doing Roth contributions, they're not doing pre-tax contributions, which means they're not getting tax deduction. So that in itself is a win, and that's why politicians like Roth, even though long-term it's not very helpful. So there's going to be an option to at least have these employer matching contributions being Roth. The next thing that's interesting too, they want to basically allow for 401k plans to provide matching contributions on employee student loan payments. Okay, so they essentially want to allow the employer to use these matching contributions to help pay the student loan. Okay, which we know we have a major student loan crisis in this country. There's tens of billions, if not trillions of dollars related to student loans, where many instances people just can't pay them back, right? They ultimately never graduated, or it was just a poor investment because the jobs they ended up receiving based off the education just didn't make it worth the loan. I give this example. One of my good friends who I started practicing law with in 2001, 21 years ago. And again, we worked at top law firms making six figures, right away. he's still paying off the loan 20 years later. He lives in Long Island. He's got 2 kids, right? So he can't just pay it down. Now he actually is in-house at a company, but he's still paying off some of those loans, right? He has to take kind of a holiday for some time. So it's not so easy. And this guy's, a lawyer making 6 figures. So it's a big issue. So I think I kind of commend the House and Senate for this, for giving employers a chance to add some cash to the employee to help pay these student loans. The next thing I want to touch on is catch-up contributions. So essentially, contributions, let's say for 401ks, the $6,500 amount, they want to force employers to do it in Roth. Okay, it's questionable whether this will pass. This is pretty extreme. The idea is that, hey, if there's a catch-up, you have to pay tax, it's after-tax money, but we'll let you keep that money in a Roth 401k instead of allowing it to be tax deductible and keep it in a pre-tax 401k account. So this is unclear. It's both in the House and the Senate bill. But again, this is kind of controversial. There's been some pushback. Some people are resisting the kind of the force nature of the provision, where they're forcing you to do Roth, take the income, take the contribution into income, pay tax on it, and then have it in an after-tax account versus getting that deduction and having it in a pre-tax 401k. So we shall see how that goes. But right now, it's in the House and the Senate. I'm just not sure if that's actually going to pass. What else I want to touch about? This is interesting. So anyone between 62 and 64, the EARN Act is actually 60 to 63. They want to give you basically a bonus opportunity to put up to $10,000 away as like a bonus contribution. Okay, so this is interesting. In a 401k, it's generally $6,500 if you're over 50. They want to give you either between 62 and 64 or 60 and 63 under the EARN Act, and they'll have to agree what the age is. A $10,000 bonus opportunity. Obviously, they're not just giving you the money. You have to put the contribution in, but they're allowing you to put in more than that $6,500 between those certain ages, and it will also be indexed for inflation. So that $10,000 number will go up in the future. The idea is, hey, these are your prime retirement years, and we want to give you the opportunity to stock away more dough for your retirement. Again, another great thing. My attitude is why not just do it from like 55 to 70? Why not give people the chance to put away more money? It's not just for rich people, right? A lot of middle class folks that would love the opportunity to put away a little bit more money, during those times in their working life. So I commend this, but I wish the age group was actually expanded a little bit. But I think there's a really good chance this passes. Next thing, which is super relevant, they want to add Roth components to simple and SEP IRAs. Right now, simple and SEP IRAs are just pre-tax. So they want to add a Roth component to it, basically allow you to do Roth contributions. A SEP IRA is a pure profit sharing plan, 20 or 25% of your comp if you're a W-2, up to maximum of $61,000 in 2022 if you're under 50. There's no catch up if you're over 50, but they want to add a Roth component, because one of the issues with the SEP is, unlike a solo K, which has employee deferrals and profit sharing, the SEP is just a profit sharing plan, but the SEP doesn't have a Roth component. And again, another theme is Rothification, right? They do want to make retirement planning easier, more flexible, more accessible, but they also want to add Roth components to help them out long-term from a budget standpoint, since Roth don't impact the immediate tax revenue budget of Treasury. Yes, again, long-term, not ideal, but short-term, very beneficial. So let's encourage more people to do Roth. That's going to help our budget and help us collect more tax revenue. Why will it help collect more tax revenue? Because less people will be doing pre-tax contributions, meaning less deductions, since they'll be doing Roths, which are after tax. Another thing that's interesting is right now, the Secure Act 1.0 allowed you to set up a solo K in a year and then make contributions for a prior year. So for example, starting in 2020, you were able to set up a solo K, let's say in 2021, for the 2020 year. Although from a contribution standpoint for 2020, you were relegated to just doing profit sharing, employer contributions, where you were not allowed to do an employee deferral contribution. This provision would allow for retroactive first-year elective deferrals, employee deferrals, and the profit sharing. This would be really cool, super relevant for solo plans and 401k plans. So I'm hopeful this will be passed, but it's a really good provision. What else? They want to add some, what else? Long-term care contract withdrawals. So there's some provisions here that they want to kind of expand some of the hardship stuff where they'll let you take some money out for certain events, whether it's adoption expenses or long-term care contracts. So, I thought that was pretty good. The coverage of part-time employees is next. Under the Secure Act, it's a part-time employee, someone who works less than 1,000 hours or 500 hours in 3 consecutive years. Basically, they want to change this to 2 years. Okay, so why is that relevant? As well, if you are part-time, the employee is not eligible for benefits under a plan, and thus you can potentially set up a solo 401k. Or if you're a larger company like a McDonald's or a Wendy's, you may have less employees that are covered under a plan, which means less costs for the employer. This is going to essentially have an impact on who is deemed a part-time employee by making that definition narrower. So it's going to be harder to satisfy the definition of a part-time employee and make more people eligible for a 401k, because instead of having 500 hours 3 consecutive years, it's 500 hours plus 2 consecutive years. So again, based off their theme, making it more accessible, making 401ks and retirement savings more accessible to more Americans. What else did I want to chat about? They want to make it easier for you to port rollover money from 401ks. They actually want to adopt like a standard rollover form, which makes sense, because right now, like if someone wants to do a rollover from a 401k, IRA Financial has our own plan document form, rollover forms, but your employer may, the institution may, and people just kind of use their own forms. They're kind of a mess. They're unclear. They sometimes don't have the proper withholding information or at least the proper data in terms of how the rollover works and what are some of the rules behind it. So there's a lot of issues. If the form's inaccurate, there's potential coding issues where the employer codes this as a taxable distribution instead of a rollover. I get this 5 times a week. I get clients calling me, Adam, I rolled over money from a 401k to an IRA with you, and now 2 years later, a year later, 3 years later, I got this letter from the IRS because the institution or my employer coded it as a taxable distribution on the 1099-R. They put it in box 7 instead of putting a G as in girl. They put a 1, and now I have to explain to the IRS what's going on. And yeah, it gets corrected, right? The proofs in the pudding, right? You can show that the money went from one retirement plan to a next. It's certainly very evident. We'll file a 5498 for the IRA. So we'll assist you with it, but it's still kind of a pain, right? Where you have to deal with the IRS and navigating a letter writing contest to make sure that the the rollover is coded properly. So I'm all about just trying to get a more uniform form where we're all using the same rollover form. What else? Hardship withdrawals, they want to make it easier, right? They want to make it less complex. And so it's going to be less of an onus on the employee to like certify the hardship, whether it's a hardship for economic purposes or a hardship for medical purposes. It's going to be easier to self-certify, which again, I'm all for it. At the end of the day, if the IRS audits the hardship, they're going to audit the plan participant. They're not really going to audit the employer. The employer generally doesn't have the fiduciary responsibility to go and investigate your financial life cycle, look at your tax returns, your bank accounts. Like essentially, if an employee certifies that they have a hardship, the employer is going to allow for it anyway. So just makes the whole process easier. Hardship distributions, remember, they're still taxable. There's just no 10% penalty. Okay, so you simply just get around the 10% penalty, but you still have to pay tax on the hardship. This next provision is super cool. they want to have like a database, a lost and found database for 401ks which are over $1,000. So what happens a lot of times is there's something called automatic enrollment, and I'm going to touch on this shortly. So a lot of people, actually millions of Americans, they start a job and they get automatically enrolled in a 401k, and sometimes they work there for 3, 4, 6 months, maybe a few years. They don't contribute to it, but the employer has, let's say, a 3% or 4% non-elective match, meaning even if you don't put in money in the plan, they're still going to give you 3 or 4% of your salary. So let's say you make 30 grand and it's 3% and you're there half a year, it's 450 bucks. Okay. But what happens? You then leave your job, you go somewhere else. You didn't even know you had a retirement plan, right? No one really, HR didn't really mention it, or maybe they did, you wouldn't pay attention. You never put money in the plan, so you didn't really focus on it. But now that 450, 6 years later is worth 3 grand, 4 grand money. So most people don't know this exists. There's something called a safe harbor IRA, where if your employer is enrolled in a program and someone leaves with less than 5,000 bucks and they don't tell the employer what to do with their money, they'll automatically send the IRA to some custodian, and it's their job to find you. But it's not, generally doesn't happen. It's like OJ looking for the killers, right? It just doesn't happen. So there's hundreds of billions of dollars of lost retirement money sitting there that no one's collecting. And there's really no repository of data where you can just kind of go online and type in your name, your social, and see what's out there. So the DOL wants to put something together. This is a great idea, and hopefully it gets done soon, because as I mentioned, there's hundreds of billions of dollars of money out there that we can use. That's our money. We just don't know it's there. So if you get one thing out of this video, if you've worked at jobs and you didn't take any retirement money with you, and the companies were quite large, 100 plus employees, you may want to give those employers a call back, even if it was 5, 7 years ago. Can't hurt, because there's a chance there's money in a retirement plan that was allocated to you that you're not aware of. And maybe that money now is moved to an IRA custodian under the Safe Harbor IRA program, or maybe they still have it in the plan. Okay. But you never know. It may be worth a call, especially if they're large institutions. There's a chance they did non-electives, or maybe even they deducted money on your paycheck that you just didn't even realize because the money was small, right? Let's say you made 700 bucks a week, paid bi-weekly, it was 1,400 bucks, and maybe they pulled 3% away, right? Maybe you didn't notice the 40 or 50 bucks gone, but it added up, and years later, that's now worth 1,000 bucks. It's money, right? In today's inflationary times with prices out of control, gas prices, food, everything, travel, who would turn down a free 1,000 bucks? So it may be worth kind of going back through your emails, your data, and just kind of looking at companies you worked for in the past, whether it's last year or 10 years ago, and just making that call to be like, hey, just checking, did I have any retirement money? I never ported it over anywhere. You have anything? And you'll be surprised. I've had people call me and say, hey, I listened to one of your videos on this and I found a few thousand bucks, so thank you. So anyways, it's worth the few minutes. They also want to offer like the minimus incentives to open 401k plans. So right now you can offer very minimal amounts, like 40 bucks. And in the IRA world, it's like 25 bucks in the 401k world as an incentive to the employee to participate, which I think is ridiculous. Like, why not? Why shouldn't the employer offer real incentives? Like, hey, if you participate in the 401k, we'll give you an extra vacation day or extra $500 bonus. Like, why are we limited? This is a good thing. We should have employers and encourage employers to incentivize their employees to save. Yes, they can do it through employer matching contributions or safe harbor contributions, but why not do more? Like, hey, you get a free massage every week, or free gym membership, or whatever it is, right? Why can't we do that? It's stupid. So they want to make it easier for employers to offer de minimis incentives, which is a good thing. So I'm all for that. The Senate version also wants to increase the savers tax credit and make it easier to get. The House bill would increase the income cutoff and expand how many people would qualify for the full credit. So again, this is generally cut off if you make 68,000 or more joint filers, but anyone making less than 60,000 joint filing, there's credits if you make contributions to a retirement account, and they want to make it easier for you to get that credit. So kudos to them. What's the main difference in the House and Senate bill? Okay, the main difference really comes down to this. It really comes down to automatic enrollment in 401ks. The Senate was a little bit less gung-ho, forcing employees into 401k plans, where the House bill encouraged and was certainly more open to having employees be automatically enrolled or forced into 401k plans. And what the House bill did is they did automatic enrollment, and they started at 3%, and they actually expanded it up to 10% over a period of time. And this excludes, obviously, certain businesses, less than 10 or fewer employees, but they want to, again, make it easier for people to be in a plan. And the studies are very clear. If you automatically enroll people, if you force people into 401ks, they're going to save, right? That's one of the issues of America. We're not great savers. We love to spend money. We like to gamble. We like to have fun. We don't like to save very much. If you look and compare us to countries in Asia, even some European countries in Canada, for example, we don't do a great job at saving. Our saving rate is quite low. So the thought is, hey, let's just force people into 401ks. They may not even know. Yeah, you can opt out, but let's opt them in, because the studies are clear that there's much less people that will opt out than opt in. So if you opt them in immediately and automatically, there's a greater chance you're just going to stay in the plan and save for retirement versus forcing them to proactively elect to be part of a plan. So let's just opt them in. The Senate basically did not propose automatic enrollment. There's a provision that would require auto enrollment plans to check every 3 years, but there's no provision that forced automatic enrollment where the House bill does. So that's the main difference between the House and the Senate bill. One other thing I forgot to mention, they want to expand contribution limits for simple IRAs and increase it from 14 to 16,500, make it also a catch up and index it for inflation. So we'll see about that. That probably will pass, and that can also apply to simple 401ks as well. One other thing on simple IRAs, the last thing I'll mention before I conclude, is that right now, if you have a simple IRA, you have to wait 2 years before adopting a 401k. They want to get rid of the 2-year rule and basically allow you to go into a simple automatically. Actually, go into a 401k from a simple automatically. So that's good. I always thought the 2-year window was kind of arbitrary. It made no sense. So that's it. That is, in a nutshell, pretty much the House and Senate bills. I've combined the provisions, as I mentioned. The real only difference is with automatic enrollment. Otherwise, it's essentially the same provisions. This will get passed. There's obviously consensus for it. I'm super excited about it. I don't really have any negative. The only thing is I haven't seen anything allowing Roth IRAs to be rolled into Roth 401ks. I heard that was going to be part of the Senate bill. I haven't been able to find it. So that's the one thing that I hope could ultimately get included. But again, they added Roth components to SEP simples. They took away Roth RMDs for 401ks. So they did a lot of great stuff, made portability easier, expanded the RMD age, expanded hardships. Overall, super positive bill. Yes, would I love them to remove UBIT from retirement accounts, allow for retirement accounts to invest in collectibles? Yeah, I would. I'm not sure that's going to happen anytime soon. But we're on a good footing. If you look at where we are today versus where we were in the fall with the Build Back Better bill, where there was, at least at that point, pretty aggressive push by some of the House Democrats to add a lot of investment restrictions on IRAs. Thankfully, that I got pulled off the table pretty quickly. But now, again, this is a very good example of working together, consensus building. This is the way Washington should work. Democrats, Republicans should be working together to find common ground, not a take it or leave it or all or nothing approach, which we saw, unfortunately, in the Build Back Better bill. And I believe that's why it didn't pass. I feel that if the Democrats came out and listened to the Republicans and kind of try to work together instead of coming out under budget reconciliation, just try to stuff a bunch of provisions down the Republicans' throat, we would have had better results. Now, this is not just a Democrat thing. The Republicans have done the same thing under Trump. This will ultimately continue to happen, which is stupid, because ultimately, if you can't work with your counterpart, things don't get done. You have to gradually work and get things done over time. You can't just completely change the retirement system overnight. And that was the issue with the Build Back Better. If you look at Secure Act 1, if you look at Secure Act 2.0 now, which this is ultimately what will happen and what it will be labeled as, it works because the House Ways and Means and the Senate Finance Committee work together. And they worked and kept to the theme of more accessibility, more flexibility, and cheaper, easier way to access retirement plans for all of us. And I think they've done a really good job, and I think ultimately have reached their goal. So that is the breaking news on the Senate retirement bill. I'll obviously keep you guys in the loop what's going to happen in the coming months. Probably not much chatter in the next few months. It's summer, but I would think in the fall you're going to hear more, and ultimately a bill will get passed towards November, December, which President Biden will sign, and hopefully we'll take advantage of some of these great provisions, like the extended RMDs or the Rothification stuff, or even automatic enrollment, which I have no issue with. Right? I'm a big believer in the retirement system. It's based off simple math, deferral, compounding returns. Your money grows faster without tax. The retirement system is the best way to take advantage of the power of compounded returns and deferrals. So why not force more people in, right? I'm a parent. Sometimes you got to force your kids to do stuff, whether it's encouraging them with pizza parties or baseball cards or not, or just forcing them into it. Here, the DOL, the Treasury, Iras are saying, hey, we know you guys aren't great at saving, America. So we're going to kind of just force you in here. And you can always opt out. We're not locking the door. You can opt out and walk out that back door, but it's going to be it's going to require you to actually proactively opt out. And hopefully you're not going to do that. And then ultimately the money will just be pulled from your paycheck. You may not even notice it. And in the years that follow, you're going to have a good size retirement account because of the power of compounded returns and deferrals. Your money doubles every 8 years, assuming an 8% rate of return. So if you get people in early and they just are consistent and they trust the process, they will have 6 figures plus at retirement in a retirement account. So again, I'm all in favor of this. I think it's great stuff. Actually proud of our members of Congress and our senators for working together and almost unanimously passing both the House and the Senate bill. So good stuff. And of course, I will keep you guys in the loop when any breaking news occurs based off this bill or any other retirement legislation, or of course, case law regarding self-directed retirement accounts. So thank you so much for spending some time with me today. Really appreciate you guys. And have a great day. Take care.